All right, welcome everyone. Happy to have you here. Subsequently, I would be making videos on lessons that I think are a little bit more complicated to understand from just text. I'm happy to be sharing my knowledge, my information of how I've been able to use trading to change my life for the better. And I'm hoping you guys can do the same. So let's jump right into it really quickly. So this video is based on Module 1, Lesson 3, how to determine bias, and just basically answering the question of where price is going. So the simplest way to put this is finding the next draw on liquidity. As previously mentioned, price gravitates towards the next available liquidity, searching for buy orders at old lows, sell orders at old highs, or just filling up market inefficiency. Fair value gaps. Determining your bias is typically done on a higher time frame, i.e. the monthly time frame, the weekly time frame, or the daily time frame, which dictates our decisions on lower time frame. This is commonly referred to as top-down analysis. So when you get on your chart for a trading day or for the start of the week, basically just want to start looking for your bias and start taking cues and using those cues to determine where price is going to move for that week, what price is going to do for that week. I typically start my analysis on the weekly time frame at the start of the week, the night before Monday. So Sunday evening, after all the weekend vibes have been done, all the sort of weekend stuff have been done, I get on my chart and I'm getting ready for the week, marking my chart up, finding fair value gaps, swing highs that I think price might be going for, and just getting ready for the week in general, right? Then I move to the daily time frame and then to the 4-hour time frame. Then I take my entries on the 15-minute or 5-minute time frame. So this is basically a top-down analysis. But right here, this lesson is basically telling you how to determine bias on the higher time frame. You know, when you get on your chart, you typically start your analysis on the higher time frame. The first question you want to ask yourself is, where is price going? When you get on the weekly chart, you want to ask yourself, where is price going? When you get on the daily chart, you ask yourself, where is price going, right? So that's basically what this lesson is about. There's a lot more involved when it comes to determining your bias on the weekly chart or the daily chart. And if you are a swing trader, the monthly chart. We'll touch on everything else in later lessons. So right now, let me hop on a chart and sort of show you briefly what this means, what this is talking about. All right, so I'll see you on the chart. All right, welcome to the chart. This is the GBP USD weekly chart. And this platform is called Forex Tester 6. I'll be alternating between this here and TradingView to show you more recent data. We would be using this platform to trade older price data so that we can learn a lot faster. We can basically play price forward so we can see outcomes. So right here, when you get on your chart, you're ready to trade. It's Monday morning, you're feeling good, you're feeling very energetic, new opportunities, right? So you get on your chart, on your weekly chart, and then you ask yourself the first question, where is price going? And then it just sort of brings everything, ties everything into a better perspective. So right here, we see that price has traded into a fair value gap. We went over what a fair value gap is in previous lesson, right? So that price just traded inside there. It's a level of liquidity. Grab that liquidity. So we should be getting a reaction from there. Should be getting a reaction from there. And I always tell people to not be afraid to mark up their chart. Just mark it up. I'm going to change this to a different color. All right, so that area right there signifies a weekly fair value gap. So where is the next draw on liquidity? Because we should be getting a reaction from price trading inside this fair value gap. The next draw on liquidity is right here. Next draw on liquidity is right there. All right. So this is a weekly chart, and it does take a while for price. Remember, every candle on this chart took a week to form. So you can imagine, if we have a candle, we're on this candle right now, we just might not get there for this week. Let's say, but it is a direction. It is a direction, and then it also goes to mention that price moves in a particular pattern, right? There's a pattern that price moves in. If it was going to sell, it would be selling this way. Price does this, right? It pushes, pushes, and then it does a pullback, and then a push again, a pullback, and then a push again. This is how price moves in a downward direction. It doesn't just go in a straight line. And for the other direction, price does a push, and then the pullback, and then the push, breaking structure to the upside, pullback, and then the push. So that is the typical manner in which price moves, right? So price is not just going to go on a straightforward line to this point, but this looks like a small gap until you move to a lower time frame and see that there's actually a lot more going on down there, a lot more that you have to look out for. So this is a weekly sell side liquidity. All right. So weekly sell side liquidity. That's basically for the weekly time frame. You don't have to complicate things too much. This is where we'll be expecting price to go to for a while. All right. So you'd be expecting what sells, but it doesn't end there. You have to go to the daily chart. And when you do that, you are going to see that there's a lot more activity going on. So right here is the daily chart. This area is that weekly fair value gap that we're coming from. This is that weekly sell side liquidity that we determine that price should be going to. But right now, when you drop to the daily chart, you see a lot more going on. You see more swing lows. Remember a 3-candle formation with one candle higher on the right and the other one higher on the left marks a swing low. And what is resting at a swing low? Sell side liquidity. So buyer orders waiting there to be grabbed and taken to the upside, right? So we see a reaction from price hitting that weekly fair value gap into where? Into a daily fair value gap right there. I'm going to make this another color so that we can sort of differentiate it. All right. So let's make it blue. So a daily fair value. You saw that price traded into there. This candle right now is the daily candle. This is where we're on for the day. And say you are trading on that day, what would you be taking? Well, price just reacted from a fair value gap. It has to look for the next draw on liquidity. Where is the next draw on liquidity on the daily chart? This is ultimately where we determine that price is going to, but price doesn't just push down. Like we said, price moves in a particular pattern. When there's a push, like a candle like this, that falls into an institutional level, a fair value, daily fair value gap in this instance, is going to look for the next draw on liquidity. And if you can see, there is another daily fair value gap here, just the tiniest one right there. So that is the next area that price should be reacting from, right? We've determined that price is getting down here. This is where you're going to get down to, but it has to do a certain things before it gets down there. It's going to react from level to level of liquidity, sweeping lows, entering fair value gaps, and just behaving in that pattern, right? So if you play price forward here, if I push this button, this bar forward button, we'll see what price will do next. So voila, we see that it traded into that fair value gap and immediately went for this low, this daily low. If I can mark that out, you see that price just swept it. See that price just swept it right there, just by a little bit. I'm going to take this square off, a rectangle off. So you see price traded, this candle traded below this bearish candle, right? So swept that liquidity. Now we're going to expect a move into the opposite direction, because here also we traded into another block. So We have to, but ultimately we know that price should be coming here, right? But on our daily basis, we have to be checking the daily candles. We have to be seeing what it's doing. If we're looking for sales on that day, it's traded up first. And probably in New York, if you were looking for sales, you'd have gotten a sell run because it did come down for that day into this area. So it's probably going to take a while. It's probably going to take price a few days to trade down to that weekly sell side that we have. But we do have bias. We have a weekly time frame bias. Price should be selling to this level. On the daily time frame is a little bit more shiftier, is a little bit more shifty. So I'm just going to play the candle forward. Let me move the candle one forward one. So we see what happens. Swept that liquidity, right? Swept those lows. And we get a reaction from that. Closed below it. That's a good confirmation that price is moving down. That means we have this level of liquidity to aim for on the daily, right? I'm not saying you are going to be correct every day. This is probably an area where price will beat you up just a little bit. But what saves you is all these rules that we have. We have so many rules that you have to take off before you take an entry. So don't worry about price beating you up there or you taking losses when you can just control yourself enough and make sure that you check off all your boxes before you enter a trade. Your rules end up saving you in this instance, in this scenario. It tapped a fair value gap here. Should be looking for next draw liquidity. It fell short of that, creating a swing here. Moved again, swept both lows, equal lows here. These two candles, this one and then this other one, this other bearish candle formed equal lows there. That is a very attractive level of liquidity that price always likes to go for. And then on this day, say you were looking for more sales because it swept, or you were looking for buys for price to come into this swing high. We have what we call a failed swing there. It didn't get up there. Good indication that price still wants to go down. On the next day, it closed with a body below this low. If you look closely there, just going to take this off. If you look closely, there's a swing low. That is a swing low. Price just traded below it. So my next instinct is that price is coming down here. So for the next day, I'll be looking for sales. Just out of curiosity, let's see what happens. We got a sell. It ended as a bullish candle, but remember, price will trade down first in order to create this wick. That is what this wick means. Price traded down first and then traded up and then closed. A little concept we know as power 3 happened there. Price traded down first, and that's what creates wick on both sides of a candle. We'll be going over that in a subsequent lesson, but I hope you get the idea of how we can just find our bias on a higher time frame standpoint, right? Before we make our decisions on a lower time frame. The 4-hour time frame is a little bit more complicated, a little bit more shifty. So I won't go over this in this lesson. On a subsequent lesson, there will be a video dedicated for the 4-hour chart. All right. So I hope that's clear. I hope you got something out of this video. So let's move to the next lesson, and as we go forward, it will start to become clearer and clearer, and you start to understand your way around these markets, right? All right, so see you then.